Buying your first home is really difficult. In the last 2 years, when the house prices have actually gone up by 20 or 30%, buying the first home for first home buyers has become really increasingly difficult. And right now, with rising interest rate, with rising cost of living, borrowing capacity is also affected. And so for first home buyers, it's been a rough 2 years, and it's still very rough for them to get into the housing market. With just young buyers, it's already difficult. But what if you're a buyer in your 50s and you want to buy your first home? And of course, you know that like the banks will only assess you with a 20-year loan term. What are the ways for you to actually apply for a loan and get approved for the loan and hopefully get approved for a 30-year loan with a minimum of a 20-year loan? So here are my ultimate tips for buyers in their 50s, late 40s, early 50s, who want to purchase their first home, who wants to get into the property market, especially now that the prices of properties are correcting. My first tip is have that 5% genuine savings. What do I mean by genuine savings? That 5% of the purchase price has to be sitting in your account the last 3 months. You have to have at least that 5% savings to buy your first home. Let's say you want to buy an apartment for $600,000. So you need a minimum of $30,000 to be able to apply for a loan. Genuine savings is very important because the banks want to see how you behave financially. Another tip, my second tip, is for you to save more than the 5% deposit. It would be great if you can actually save at least 10% deposit. Simply because if you're doing land and construction, most banks will do the loan at a 90% loan to value ratio. So having the 10% deposit for a construction loan is very important. It also reduces your LMI, especially if you're not qualified for the first home loan deposit scheme. Third tip, spend less in the 3 months before you apply for a loan. Mature age borrowers have a lot of disposable income, but you have to show the lender that you can afford the loan that you're applying for. So in the 3 to 6 months before we apply for a loan for you, kindly reduce your expenses such as clothing, recreation, and of course all the discretionary spending you've been doing. Lenders are scrutinizing your living expenses. The high discretionary spending reduces your borrowing capacity. My fourth tip is to keep your bank statements, transaction accounts, and ongoing liabilities in order. Banks have access to your credit report, so you know that you have a credit score, and that credit score determines whether the bank will lend you the money. And so you have to keep them in order in such a way that there are no defaults, there are no late payments, because if you do, they will actually hit your credit report and it will show in the credit reports that the banks have access to. Just keep them clean, and if you have ongoing liabilities and you're not using those cards anymore, just cancel them. If you use Afterpay, those buy now pay later schemes, they will also appear in your credit report. So we have to declare them to the bank. And again, this buy now pay later schemes facilities affect your borrowing capacity as well. My fifth tip is try not to switch employers when you are applying for a loan. Banks want to see that you've been with your employer for at least 2 years. This shows employment stability. There are a few lenders, probably 2 or 3 lenders, which are okay if you're new in the job. So let's say you've been in the IT industry in the last 2 years and then you switch jobs. You move into another job, still doing your IT work. As long as we're able to provide a pay slip, then banks are okay with that because historically you've been in that industry. You've been an IT person for more than 2 years. With casual work, banks want to see that you've been doing that casual work for 6 months minimum before they're able to accept that income for servicing. So employment and income stability are very important. Most of the lenders would require that you have at least been with the company for 2 years. The 6th most important tip that I can give for first home buyers who are mature age borrowers to mitigate the age issue is to have a lot of money in your super. So how we calculate is like, let's say you're in your 50 and you're given a 30-year loan term by the bank. That is because there's a lot of funds in your super that when you retire at the age of 70, the bank knows that the super can manage the repayment of the loan, the left loan balance of 10 years, and you have enough money in your super to pay this out, or enough money in your super to actually still doing the repayment, whatever is the loan balance left for the 10 years. That's a very important tip that I'm providing for first home buyers who are mature age borrowers. If you're a first home buyer, speak to us, give us a call. My name is Maria Papa. I've been doing mortgage broking in the last 11 years. My number is 04301 44008. You can email me at mpapa@maverickfinance.com.au. You can check out our website. We're on LinkedIn, we're on Facebook, we're on Twitter, we're on Instagram. Just Google us and you'll find us.